Debt often carries a negative connotation, primarily associated with financial struggles, high-interest loans, and relentless repayment cycles. However, for the wealthy, debt serves as a powerful tool to create and multiply wealth. Rich people use debt strategically, turning it into an asset rather than a liability. By leveraging borrowed money, they maximize their financial opportunities and secure long-term returns that far outweigh the cost of the debt itself. This video explores 5 ways rich people make money with debt, providing insights into their strategies and how they use this financial instrument to their advantage. Leveraging debt for investments. One of the primary ways wealthy individuals use debt to build wealth is by leveraging it to invest in high-return assets. This strategy, often called using other people's money (OPM), allows them to amplify their purchasing power and earn profits far exceeding the cost of borrowing. For instance, a rich investor might take out a loan to purchase real estate, stocks, or businesses. If the annual return on the investment is higher than the interest rate on the borrowed amount, the investor effectively earns a profit on borrowed funds. Real estate is a classic example where this principle shines. Wealthy individuals often use mortgages to acquire properties, renting them out to generate income while benefiting from property appreciation over time. In the stock market, margin trading follows a similar concept. Here, investors borrow funds to buy additional shares, multiplying their potential gains. While margin trading involves risks, seasoned investors often use this strategy with careful analysis and market knowledge to enhance returns. By leveraging debt, the rich expand their investment portfolio without tying up their own capital, allowing them to maintain liquidity for other ventures. This calculated use of debt enables them to maximize opportunities and grow their wealth exponentially. Tax benefits from debt. Another significant advantage of using debt is the tax benefits it can provide. Many forms of debt, such as mortgages, business loans, and investment-related borrowing, come with tax-deductible interest payments. For the wealthy, these deductions lower their taxable income, reducing their overall tax liability. For instance, in real estate, interest paid on mortgages is often tax-deductible. Wealthy property owners use this provision to their advantage, acquiring multiple properties and writing off significant amounts in interest payments. Similarly, business loans allow entrepreneurs to deduct interest expenses as operational costs, lowering the effective cost of borrowing. Debt also helps the wealthy minimize taxes on their investments. Instead of selling assets and incurring capital gains taxes, they can take out loans against their investments. This method, known as asset-based lending, allows them to access funds without triggering taxable events. For example, a billionaire with a substantial stock portfolio can borrow against it, using the loan proceeds for personal or business expenses while keeping the portfolio intact. These tax-efficient strategies enable the rich to save on taxes while maintaining access to capital, further fueling their wealth-building endeavors. Scaling businesses using debt. Entrepreneurs and business owners often use debt to scale their operations, expand their market presence, and increase profitability. Debt financing enables businesses to invest in new products, infrastructure, marketing campaigns, or acquisitions without diluting ownership through equity funding. Wealthy business owners strategically use loans to seize growth opportunities, ensuring that the returns from expansion exceed the cost of borrowing. For instance, a restaurant chain owner might take out a loan to open new locations. If these locations generate enough revenue to cover the loan repayments and then some, the business owner effectively grows their wealth using borrowed funds. Debt is also a key tool for mergers and acquisitions. Rich individuals and corporations use loans to acquire competitors or complementary businesses, increasing market share and revenue streams. By leveraging debt, they achieve exponential growth while retaining control over their companies. Moreover, business loans often come with favorable terms, such as low interest rates or extended repayment periods, making them an attractive option for wealthy entrepreneurs. This allows them to achieve scalability without depleting their own resources, keeping personal and business finances separate while reaping the benefits of growth. Real estate development with debt. Real estate development is a vital wealth-building tool for the rich, and debt plays an indispensable role in this industry. It enables investors and developers to scale their operations, manage risks, and achieve returns that might otherwise be unattainable. By leveraging borrowed capital, they can finance projects, acquire properties, and convert liabilities into wealth-generating assets. The power of leverage in real estate development. One of the key advantages of using debt in real estate is leverage. Leverage allows investors to control valuable properties with minimal initial investment. For example, by securing a mortgage or a construction loan, A developer can build a commercial plaza or residential complex with only a fraction of the total cost paid up front. As the property appreciates over time or generates rental income, the returns on the initial investment are significantly amplified. Consider a developer who secures a $10 million construction loan for a luxury apartment building. They invest $2 million of their own capital as a down payment. Once completed, the building's market value might rise to $15 million, and rental income could provide a steady revenue stream. After repaying the loan and covering associated costs, the developer retains both the property and the equity created by its appreciation, all while having used other people's money to finance the project. For wealthy investors, debt is not just a means of financing a single project, but a strategy for scaling their real estate portfolios. Instead of using all their available cash to fund a single development, they spread their capital across multiple projects by borrowing. This diversification reduces risk and maximizes growth potential. For example, a real estate investor might use loans to acquire several rental properties simultaneously. Each property generates rental income, which is used to repay the loans. Over time, the investor builds equity in multiple properties, creating a robust and diversified portfolio that generates long-term wealth. Debt is also crucial in property flipping, a popular strategy among wealthy investors. In this process, an investor secures a loan to purchase an undervalued property, renovates it, and sells it at a higher price. While the loan incurs interest, the profit from the sale often far exceeds the cost of borrowing. For instance, an investor might purchase a distressed property for $300,000 using a short-term loan, spend $100,000 on renovations, and sell the property for $500,000. After repaying the loan and covering renovation costs, they are left with a profit of $100,000. This strategy, repeated at scale, can generate substantial wealth. Sophisticated real estate investors understand how to structure debt to minimize risks. Fixed-rate loans provide predictable costs, while interest-only loans can reduce initial outflows during the construction phase. Additionally, partnerships with lenders often come with favorable terms, such as delayed payments until the project begins generating revenue. Creating passive income with debt. The wealthy use debt to generate passive income streams that provide financial security and long-term growth. By investing borrowed money into income-producing assets, they create recurring revenue that often covers the cost of the debt while generating profit. One common example is rental properties. Wealthy investors use mortgages to acquire properties, renting them out to tenants. The rental income not only pays off the mortgage but also provides a steady cash flow which can be reinvested into other ventures. Over time, as the mortgage is paid down and property values appreciate, the investor builds equity and wealth. Another example is dividend-paying stocks. Using loans to purchase shares in stable, high-dividend companies allows investors to receive regular payouts. These dividends often exceed the interest costs on the borrowed money, creating a net positive income stream. Infrastructure investments, such as toll roads, parking lots, or energy projects, also offer opportunities for passive income. Wealthy individuals and organizations use debt to fund these projects, benefiting from long-term revenue streams once they're operational. By channeling borrowed funds into assets that generate consistent returns, the rich create self-sustaining income sources that grow their wealth while minimizing the impact of debt repayments. For the wealthy, debt is not a burden, it's a strategic tool. By leveraging debt for investments, taking advantage of tax benefits, scaling businesses, developing real estate, and creating passive income, the rich turn borrowed money into a wealth-building asset. The key to their success lies in their ability to manage risk, plan strategically, and maintain financial discipline. While these strategies are effective, they also require expertise and careful execution. Misusing debt can lead to financial troubles, even for the wealthy. However, with proper knowledge and guidance, the principles of making money with debt can be applied on a smaller scale, offering lessons for anyone looking to grow their wealth responsibly. Ultimately, the way the rich use debt demonstrates the power of financial literacy and strategic thinking. It's not about avoiding debt, but about understanding how to make it work for you. So that's it for today. If you like this video, then please hit the like and subscribe button for more videos. Thanks for watching.